everyone, I'm the tax pro, and today we are going to go over equity in the chart of accounts. So there are other videos that so far have gone over summary of what the chart of accounts is and why it's important, assets and liabilities. Now we're going to touch on the equity section, which is the last portion of the balance sheet. And then we'll move on to revenue and expenses. Equity is kind of a weird beast. So make sure that you understand what the chart of accounts is and why it's important, and let's kind of dive into what is equity. So going into the chart of accounts, you can either go over here to transactions and then go to chart of accounts, or you can come up to this gear icon and go under your company, chart of accounts. This is a list of all the chart of accounts for the whole company. There are account types and account details here, and you'll notice that if we scroll down enough, we end up with equity. And so I'm going to show you where equity lives on the balance sheet to explain what equity is and how we set up the chart of accounts for equity. Because it's going to be dependent on the way that you're taxed, and equity is kind of a weird concept. So equity lives on the chart of accounts, on the balance sheet. And the balance sheet, the way that this is structured, is assets equals liabilities plus equity. So when we add liabilities and equity together, we get assets, okay? This is an important concept because equity is kind of, in a way, an estimate. So the reason that equity is important, one, it's important for some tax purposes that I'll discuss here in a minute. But two, it is an estimate of what the owners or owner of the company would receive if the assets were liquidated and we got exactly book value for those assets, and then we paid off all of the debt of the company, and we paid that all off for the value on the books, okay? In reality, that doesn't happen. Very rarely does it happen that we can liquidate all the assets and get exactly book value, because some assets are just recorded oftentimes for tax purposes. So we may have a truck sitting on there that maybe we've taken a lot of depreciation on and it's showing that it's worth $10,000, but maybe we can sell that truck for $40,000. So equity is, in a way, an estimate on the balance sheet. However, it does come from real numbers. And it is important for certain types of entities to track what goes in and out of those accounts. And the way that the business is taxed is going to determine how we set up our equity accounts. So to set up your equity accounts, we first need to know how you're taxed. There's a couple of different options, and I'm going to run through them really quick before I go into setting up your chart of accounts. If you are the only owner of the business and it either does not have a formal formation type like an LLC, or it does have a formal formation type and it's something like an LLC, so it's not a corporation, but maybe it's an LLC, that business is technically, by default, for federal income tax purposes, taxed as a sole proprietorship. If the business has more than one owner and it is not a corporation, it is by default taxed as a partnership. So it's pretty much the same as a sole proprietorship, except it has more than one owner. That is a partnership, okay? Now, if the company is a corporation, it's structured as a corporation on the state level, that company is taxed as a C corporation, okay? Now, we also kind of have the option to elect to have our businesses taxed differently. So we can elect to have like an LLC taxed as a C corporation. We can also elect to have businesses taxed as an S corporation. An S corporation is a tax election. It is not an entity type. So it's not like we go to the state level and we form an S corporation. You would form either like an LLC or a corporation, and then you would elect to have it taxed as an S corp. So it's just important that you understand how you're taxed, because that's going to determine how we set up your equity section. Okay? And I'm going to run through each of these scenarios really quick, and I'm going to explain what they look like. So this is our balance sheet. I'm going to leave our balance sheet here, and I'm going to go back to our chart of accounts in a separate window. First, we're going to do a sole proprietorship. A sole proprietorship is going to have a couple different equity accounts. So you're going to have an owner's capital account, which is where all of the contributions to the business are going to go. So if you are the sole owner of the business, every time you put money into the business, it's going to go into owner's capital. Every time you take money out, it's going to go into owner's draw. And so that's going to reduce owner's capital. At the end of every year, when you close the books, you should close owner's draw into owner's capital. Okay? So we zero it out and reduce owner's capital. QuickBooks Online is automatically going to create this retained earnings account. It's not something that we can avoid. So it's just going to be there. And that is what QuickBooks Online is going to put all of the profit into when it closes the books. So at the end of the year, if your profit and loss says that you made $100,000, it's going to put $100,000 into your retained earnings. Okay? Technically, retained earnings doesn't exist for many different types of businesses, but we're just going to go with it because that's how QuickBooks Online operates. Okay? So retained earnings is going to be there, and it will actually be closed into owner's capital as well for a sole proprietor. Opening balance equity is an account that QuickBooks puts in here. This should in all actuality have a $0 balance once you get your books ready. Okay? So I'm going to show you what the equity section looks like for a sole proprietorship. What you're going to have here, opening balance equity in all reality should go away. Okay, I'm just going to leave it there for simplicity's sake, because if you have it there, I want you to recognize, one, it's there, two, it needs to go away. Owner's capital is going to be here along with owner's draw, because this is what was put in and what was taken out. Retained earnings are going to be earnings from last year, and then net income is what our net income is so far this year. Okay, so QuickBooks will actually close net income into retained earnings at the end of the year. So we don't have to worry about that. So this is what the equity section will look like for a sole proprietorship. However, if you have this opening balance equity, we need to adjust it out, which I'll explain that in a completely separate video because it's really common. Now, so we did sole proprietorship. Let's talk about partnerships. In partnerships, each owner is going to have its own owner's capital and owner's draw account. So I'm just going to edit this real quick. And I am going to go ahead and put together two separate equity accounts here. I'm going to put, you shouldn't really use the opening balance, but I'm going to use it for right now, just for simplicity's sake. Now I'm going to show you what this is going to look like when we have multiple owners. Okay. So each owner is going to end up with their own capital and draw account. And each owner, when they contribute money, it's going to go into their equity account or their capital account. And then when or when they contribute money, and then when they withdraw money, it's going to go into their drawings account. So let me show you what this looks like when you have multiple partners. Each partner will have an owner's capital account. So Bill has an owner's capital account and Susie has an owner's capital account. Each owner is also going to have an owner's draw account. So Bill has an owner's draw account and Susie has an owner's draw account, okay? Opening balance equity technically should not be here, and I will discuss this in a different video. So I'm just going to leave it here because every time we see it, I'm going to reiterate that it shouldn't really be there. And then at the end of the year, QuickBooks will close net income into retained earnings. At that point in time, retained earnings then gets separated into each capital account for each owner based on that owner's share of income, okay? I'm gonna go over closing the accounts. So this is really just for setting up the capital accounts. I just wanna give you a little bit of context. So point being is each owner should have a capital account and a draw account if we are talking about a partnership for tax purposes. Each owner should have a capital account and a draw account. And then opening balance equity technically shouldn't be there. I'll show you how to fix that. You'll also end up with a retained earnings and a net income account, okay? So that's the equity section for partnerships. Now, if we have a corporation, we end up having, I'm gonna make these accounts inactive. QuickBooks might not like this. I might have to adjust some of these out. Let me actually, I'm gonna pause this video while I adjust some of these out because it's gonna show balances even if they're inactive. I'm gonna first show you how to create a stock account and then I'll adjust it out and show you how that should look. So when it comes to a corporation, corporations don't have owner's capital accounts for each owner. Think of like Apple and Google. Apple and Google are corporations, and they are structured very similar to what a small business corporation is going to be. You're going to have stock in that particular company. And so we are going to have common stock in our equity area, okay? You are potentially also going to have like additional paid in capital and other types of stock like preferred stock, but basics are going to be common stock, okay? If you have other types of stock, you're going to have other types of accounts. So what's going to happen with your equity, I'm going to throw in some common stock in here. So the common stock is going to be the amount that was paid for the stock into the business. So we have common stock right here. So when you have a corporation, a C corporation, you're going to have common stock, net income, and retained earnings. Opening balance equity should not be there. Okay, I adjusted out those equity accounts and it dumped it in there. So this I'll show you how to adjust in a later video. Now, corporations, when you draw money, they are considered dividends for C corporations. So we are actually going to also create an equity account, and we are going to call it dividends. And it doesn't have a dividend account, so we are going to pick, we'll just make it an owner's equity. So when we refresh this, what we're going to end up seeing, I gotta put some dividends paid out. So let's say that we paid out $20,000 in dividends from the checking account. So now we're going to see retained earnings and net income. So this retained earnings is income from prior years. Net income is income so far this year. This will eventually be closed into retained earnings. Common stock is the amount that was paid into the company for stock. And then we have dividends. So this is the amount that got paid out as dividends. Opening balance equity technically should not be here. And I'll show you how to adjust this out in later videos. So this is what a C corporation looks like. For S corporations, it is going to look almost exactly the same. We generally call dividends distributions in S corporations, so this will probably look like shareholder distributions. And then when it comes to S corporations, you can only have one class of stock. So with C corporations, eventually we might have like common stock and preferred stock. S corporations can only have one class of stock, they can only have common stock. Okay? So that is your equity section. So you should know, based on this video, how your business is taxed, either as a sole proprietorship, partnership, S corporation, or C corporation. And you should know the type of equity accounts that you should have. You can't just get rid of the opening balance equity. Okay, that's why I left it in here so you guys could kind of see that it's going to kind of be annoying to get rid of. You can't just make the account inactive. It is a placeholder account that QuickBooks has on there. If you noticed, when I deleted or made inactive the equity accounts in the partnership, it threw it into opening balance equity. And so it's an account that essentially says, hey, you got some wonky stuff going on. So we're going to put everything in opening balance equity, but you probably shouldn't have anything in here. Okay, so that is equity accounts on the balance sheet. If you have any questions, please let me know. I hope that that was helpful. If so, I would appreciate a like and subscribe, and I will see you guys in the next video.